Hey everyone, glad you're here. Did you know the Federal Reserve just lowered interest rates for the first time in 9 months, bringing them down to about 4 to 4.25%? That may sound like a small technical adjustment, but could ripple into your everyday life in ways you might not expect. From your credit cards, to your mortgage, to the return you're getting on your savings account. These shifts really can matter. And also, there's a political backdrop here that's creating a lot of debate. So stay with me, because understanding what's happening right now can help you make smarter money choices going forward. Before we start, I'd love to hear from you. Do you feel like changes in interest rates actually affect your day-to-day finances, or not really? Let me know in the comments. And while you're down there, don't forget to hit subscribe if you haven't already. It really helps us keep building this community together. Now, let's talk about what this cut actually means. For years, we've been told that lower rates make borrowing cheaper, right? Mortgages go down, credit card interest drops, and businesses can take out loans more easily. But here's the catch. In today's economy, those benefits aren't showing up as strongly as people might hope. Take mortgages, for example. Even after this rate cut, the average 30-year mortgage is still sitting above 6%. That's way higher than the 3% or so people locked in just a few years back. And because most of the market already priced in this cut weeks ago, you're not going to see your mortgage quotes suddenly plummet just because of today's news. So, does this help people who want to refinance? For many, not really. You usually need at least a half-point difference to make refinancing worthwhile. And right now, that gap just isn't there for most homeowners. If you bought your house during the pandemic lows, you're still better off keeping your current rate. Also, credit cards are another area where people expect relief. But again, the story is different. Right now, the average APR is hovering around 20%. Even with this Fed cut, experts say cardholders are barely going to notice a change. One analyst even said flat out that the Fed can't cut enough to make credit cards a cheap way to borrow. And that's the tough truth here. If you're carrying balances, this rate cut won't suddenly save you. The best strategy is still paying down that high-interest debt as quickly as you can. And one thing people sometimes overlook is how these changes can ripple into everyday prices like groceries or gas, because businesses also adjust their borrowing costs. Even if it doesn't show up in your paycheck right away, it can quietly shape what you're paying at the store. So then, what about savers? Well, this is where you might feel the impact more clearly. Over the past year, online savings accounts were paying over 5%. That felt pretty good, right? But now, with the Fed cutting rates, those returns are already slipping closer to 4.3 to 4.6%. And if more cuts come later this year, you can bet those yields will drop further. It doesn't mean you should panic, but it does mean the easy days of earning solid returns just for holding cash might be fading again. That brings up an important point. A lot of people started relying on high-yield savings and CDs for steady income. But as one analyst put it, that warm blanket of comfort may not last. So if you've been enjoying those risk-free returns, this is a good time to think about locking in. Some banks are still offering no-penalty CDs, like a 7-month one around 4%, which gives you yield and flexibility. It could be worth looking at before rates drift down even more. Now, this doesn't mean savers are out of options. Some financial advisors suggest exploring short-term bonds or high-quality corporate debt. These aren't for everyone, but they can help you earn a bit more without taking on too much risk. The key here is being intentional. Don't just assume your savings will keep earning the same rate, because they won't if cuts keep happening. And let's not forget about emergency funds. One thing this whole environment reminds us of is how important it is to have that cushion. Experts say 3 to 6 months of expenses in a liquid account, even if the return isn't amazing, is still critical. Why? Because nearly half of people who carry credit card debt got there because of emergencies, car repairs, medical bills, home fixes. Without savings, you fall back on high-interest credit, and no Fed cut is going to protect you from that cycle. So yeah, even though the headlines sound dramatic, in real life, the effects are more muted. And speaking of headlines, there's also a political story here. President Trump has been pushing hard for the Fed to cut rates more aggressively, saying high rates are hurting housing and raising government borrowing costs. He even appointed a new Fed governor who wanted a bigger cut this time. And at the same time, The White House is clashing with existing Fed members in ways we haven't seen before. Courts even stepped in recently to block an attempt to remove a Fed governor who had been appointed under Biden. All of this makes people wonder about the Fed's independence, whether they're making purely economic calls or political ones too. And that's a big deal because the Fed's credibility relies on being separate from politics. Powell tried to brush it off, saying there wasn't widespread support for a bigger cut, but the tension is clear. And for us, as everyday people, that adds another layer of uncertainty. If rate policy is influenced by politics, the outcomes could shift faster or more unpredictably than usual. Now, let's talk about investing. With rates falling, savings accounts and CDs lose some shine. That often pushes money into stocks, especially dividend-paying ones. Companies that consistently raise dividends, sometimes called dividend aristocrats, tend to attract investors when bond yields get less attractive. You might also see financial stocks benefit because banks and lenders can refinance and borrow more cheaply. But here's the thing, lower rates don't automatically mean smooth sailing. If inflation stays stubborn, real returns suffer. If we head into recession, stocks can still slide, no matter what rates do. So it's really about balance, not chasing one direction too hard. And also, remember that rate cuts don't happen in isolation. There's signal of where the Fed thinks the economy is heading. That uncertainty can create swings in the stock market, which may feel unsettling if you're watching your retirement accounts. And guess what? There's a hidden lesson in all of this. Rate cuts are more of a signal than a solution. They tell us that the Fed is worried about growth, about jobs, and about inflation not quite being under control. But they don't fix your mortgage, your credit card bill, or your savings account overnight. What they do is create an environment where you have to be more strategic. That means paying off expensive debt, shopping around for the best savings deals while they last, and not waiting for the Fed to bail you out. You know what's also important here? Perspective. The days of zero interest rates aren't the norm anymore. Now, we're in a middle zone where rates aren't crushingly high, but they're not stimulative either. That means we all need to adapt, build resilience, stay flexible, and think ahead. That's the best way to handle the ups and downs of policy shifts like this one. So let me throw the question back to you. Do you think this cut will really make a difference in your finances? Or does it feel more like background noise? Share your thoughts in the comments. I love reading how all of you are experiencing these changes, and it really helps others too. And if you found this helpful, make sure to subscribe, give this a like, and share it with someone who might benefit. The more we grow this community, the more we can support each other in making smarter choices about money. Thanks for sticking with me, and I'll see you next time.